Hi everybody, how you doing? It's Uncle Bruce here, Stock Markets with Bruce. Welcome to the show. It's Friday. Stock Markets with Bruce on Friday, June the 18th, 2021. Bruce, welcome to the show. How you doing? Did you have a good week? I think we might make some more money today. At least I hope we do. Except for one thing, I would recommend that safety tip for anyone who wants the markets to go higher rather than lower. Don't interview the president of the St. Louis Fed before the opening of the market, because the more the guy talks, the further the futures go down. I just find it amazing. But then again, it is human nature. You get some official talking about, the potential of higher inflation and higher interest rates and the economy and all that, and then you get the worry warts going, oh, going crazy. They start sounding Yoko Ono in the middle of a concert, and the Dow just drops. The futures drop like 200 points in 15 minutes, and after the interview's over, the Dow comes back up again. Because at the end of the day, it's like, well, you're talking about theoretically what we're going to do, not what we're going to do. Can you spill some beans about VACQ? Have not heard anything since the new board members joined, in plain English. VACQ, we're still waiting for the shareholder meeting to be called. As a matter of fact, we're waiting for that on all of the SPACs that have not yet turned into regular companies. We're waiting for the companies to announce their shareholder meetings to vote the takeover through. And so at the moment, we are still waiting on Gores Holdings. We're waiting on Fifth Wall acquisition, Vector acquisition, Navsite Holdings, Starboard Value. Those are the ones we're waiting on. The other three are done. Sofi is Sofi from IPOE. 23andMe is 23andMe from VGAC. And ATIP used to be Fortress. And so 3 are done, 5 to go. And we're waiting every day for it to happen. What shall I choose between these two SVAC options, January option, strike price 10, or January option 750, it costs 360? Isn't the second option better? So the $10 contract at 250, which is all premium, or the 750, 360, I'd buy the 750 if you can afford it. I would grab the 750s instantly in the money. Going to $15 a share, you got probably a $9 contract. You're close to triple your money already. So yeah, I'd look at that. Is it better to write your call option on a day when the stock is up, or does it not make much of a difference? Oh, it does make a difference to do it on a day when your stock is up. Yes, of course. Because the higher the stock goes, the higher you can write a contract option at as far as strike price goes and get a bigger premium. I have 10 calls. ME, December this year. $15 exercise, except I bought at 167. They're currently at 250. I'm thinking of waiting until about August, September to sell. Realistically, what premium do you think can go up by then? Well, again, it's a question of the stock. You're just out of the money, and if the shares are in the 2022, 24 neighborhood in the next month or so, you're nicely in the money, and you're going to have an $8, $9, $10 contract. That's an easy rollover to look at. Get out of 20, at the stock at 22, 23, roll out of those into maybe next May's, because by the time a month or two goes by, we'll have a whole bunch of new contracts to choose from. Rob, it's early days. Just sit tight, enjoy the ride. It is better to buy the shares of ME or call options. What's the better way to go? If you have lots of cash, you buy stock. If you've got medium amounts of cash, you buy a little of both. Buy stock and contracts. Get some leverage on top of your stock. If you have a little bit of money, maybe you buy contracts and get leverage instead. And that might be the way to go. On ME, if you can buy 1250s or 15s, right now the stock's 1305, 1307. Again, it's over 13. You can buy $15 calls on ME or 1750s until next January. That might be the way to go. If you say I had lump sum of money and you don't want to put it all into one call, right? Even if it was something like VAGC, because something could go wrong, even if it seems like a sure thing. I want to reiterate that when I tell you to put money into a call contract and you're buying January calls, I am taking away days like today, 440 point down day to start the Dow off the table. This is why option traders get killed on days like today. You get these markets that do this stupid sell-off that for no reason other than the possibility that there could be someday higher interest rates. Like, no kidding. What other direction can they go? They're at zero. What other direction can interest rates go? Really? You get a 400-point negative reaction to something as stupid as that. You are sitting on call contracts that expire today. You're in big trouble. And this is why I avoid at all costs short-term call contracts. I keep telling you, go long, long, long. And if you're selling them in the first 2 or 3 months, which is the point, between now and the first 2 or 3 months, you're going to be out of them at a very nice profit. And when you sell them, you're going to get a lovely time premium on top of the value of the contract with worry-free scenarios. And when you replace them, you'll replace them with contracts further out into 2022. This is why you take whatever cash you have. If you're going to buy some call options on some of these SPACs I'm talking about, you go long. This is why you do it. This is the best strategy when writing call options to go like 1 week out at the highest strike price, right? Would get less premium, but I guess the safest risk, right? It depends on just your strategy. Look, if a stock has had a really good run and then you write a slightly out of the money call beyond that, and cash in a nice premium because the stock has had such a run and then it begins to ease off, it can do a little profit taking for a couple of weeks and you're laughing, man. You're laughing at such a premium. On the other hand, you get taken out. The stock keeps going up and you get bought out. Great. And then the stock backs off. You buy the stock back at a lower price than you got bought out at, plus the premium, and you're still laughing. There's nothing wrong with getting bought out. There is nothing wrong with it. If you're going to roll expiring contracts into later contracts of the same stock, does the timing matter since the price of the later date options will also be cheaper if the stock price is down? Well, if you're selling a contract today and the stock is down, you're not getting much for that call contract. You want to roll over into further contracts, you're going to be paying more for those contracts unless you're buying a higher strike price. It doesn't matter what the stock is doing. If the stocks are up and you're getting out to roll over, you're getting out and rolling over up here. If the stocks are down, you're getting out down here and rolling over to get into here. It's all relative. The end game is, what is your real objective and where do you think the stock can really go to? If the shares of ME right now, 1280 a share ballpark, if you feel that they will reach $25, $30 a share between now and January of next year, 8 months from now, you can buy $15 calls for next January, of course, because you feel that they can go to 2025. You got a nice gain there. But today you're going to sell contracts. Maybe you've got 10s or 1250s and the stock's at 1280 and you have to contend with this price to get out. And if you're waiting to the last day, you're waiting to the last day. I'm a noob, says Paul's Guitar. I admit it. I only have buy to open and sell to close options, okay? If I buy to open on ME for January, what's a decent strike price, or how do you determine a strike price, right? Buy to open means you're looking to buy a call contract and go long on the upside of the stock. And if you're looking at ME, this is the perfect time to look at an ME contract. The stock is down to 1270. Take a look at the 1250s and the $15 call contracts for January and see if you can scoop those up. You can buy 15s if you want, or 1250s if you can afford them. Remember, whatever the price is, if the market is, I don't know what the market is, if it's 250 to 3, that's $250 to $300 is the bid ask for a contract. If the bid is 250, go 255 and don't go to 300, just 255, let the market come to you. If it's 210 to 260, go 215 on the buy. Just a nickel higher than the highest buyer, and keep an eye on the stock and see how you do. Are there any projections on what ATIP and ME may hit in a year? For example, Sofi having the $400 projection a year out. First of all, There is no $400 projection on SoFi. There is whisper rumors about SoFi's upside, and in some cases as high as 400. But there's a lot of talk about SoFi becoming a triple-digit stock, a stock at 100 and more in the not too distant future. But that's not this week or next week. That might be in the next year or sooner. You never know. On the other two, my personal opinion is the 30 handle is attainable for these guys. But I'll tell you, I think that these two companies will be a lot different looking a year from now than they are now. And they're going to be a lot better looking, different looking than they are now. A lot better, different looking. Is there such a thing? And I don't think $30 is an upside. I think that's just a springboard to higher prices. I don't think that Richard Branson and all of his pals and all the folks from 23andMe do all of what they do and have poured everything into what they've poured into this company, especially 23andMe, to have the stock go to $12.24 and let's call it a day. And I don't think $100 a share either will be enough. I just don't think so. I think these folks are going to become extremely wealthy because they own large chunks of ATIP, SOFI, and ME, Gores Holdings, and all the other SPACs. These insiders have millions of shares, not to make $1 a share, not to make $10 a share, hundreds of dollars a share. That's the upside. That's the objective. That's the game plan. You got to decide whether you want to go along for the ride with these guys. How much time to give them? What kind of risk tolerance can you have? And can you handle daily variations in stock price? Can you handle it? Can you take it? If you can, you'll get richer. If you can't, you'll blow yourselves out and you'll move on to something else. Very few can handle it. It takes discipline and it takes a real strong gut vibe that you're not shaking me out. I can handle this crap. Look at SoFi. It's now back to 23.21. It just jumped like 30 cents in 5 minutes. The good way, up. You got to get ready for this. You got to get used to this kind of stuff. ME at 12.29, down $1. You got to look at this as a bargain, not a disaster, a bargain, because this stock hasn't topped out. It hasn't even started to trade yet. ATIP at 977 definitely has not started at all. This is definitely a bargain scenario here. You got to pick it up, put it away, and say, thank you, may I have another? Keep them coming. As we hit October, November on our Jan calls, how much value could they begin to lose due to time? Well, do the math. I mean, if they've lost half the time, they'll lose about half their time value. But if the shares go up, you will have the gain on that offset by time value losses. And that's where you'll watch it. If you're selling these calls, January calls, say by July, August, you're not going to have to worry about too much of the time value going away on you because you've only lost maybe 15% of the time value with a big move on the stock. Welcome to the world of called making money. Thank you, everybody, for that. If you'd like to talk to me about a 1 hour session, you want to get together with me, send me an email through my email address, which is right here. It's the old school hotmail.com email address. Send me an email. Say, Bruce, I'd like to talk to you on a one-on-one session. When can you book me in? I'd like to make a reservation and lock it in right away.